So in this video, I'm breaking down 10 real money laundering tactics. You learn how they work, cases where they were used, and how banks could do a better job stopping them. Because today's criminals, they're light years ahead of most compliance teams. And this gap isn't closing fast enough. We're talking fake freelancers, crypto tumblers, gaming assets, and tax scams with fake invoices that launder money and steal millions from the government. Let's get into it. I'm Kevin. I've been in risk and compliance for over 15 years. From head of audit in banking in New York to chief risk and compliance officer at a Fintech in Europe. I've dealt with the pain points and learned what really works to both stay compliant and on top of the risk. So let's start with a classic, Smurfing. This is when large amounts of money are broken into smaller chunks, usually just under reporting thresholds, and deposited separately to avoid detection. The idea is that 10 small deposits look way less suspicious than showing up with 50K in a duffel bag. So from drug cartels to ticket scalpers, this method has been used for decades. Banks use transaction monitoring to flag structuring or smurfing, frequent small deposits near $10,000, which is often the threshold. These generate alerts and potentially suspicious activity reports to FinCEN. But here's the flaw. If the money is split across hundreds of mules using multiple accounts, branches, or even apps like Venmo, it becomes incredibly hard to trace. And it often adds up to tens of millions. So banks should connect accounts using other and perhaps less traditional data points. These could be mobile device IDs, phone numbers, or geolocation data. You can tie in other data using cookies on a mobile phone as well and tie all of this information together. That way, even if different people do the deposits, the technology may be able to spot any links and patterns. Privacy laws and limited information sharing between different banks and with law enforcement has made this difficult though. Let's move on to shell companies. Shell companies are legal but often abused. They're paper-only businesses with no office and no staff, just a bank account and a mailing address. It used to be about Panama or the Caymans, but now you can set up a shell company in Delaware or the UK and it looks totally legit. The Danske Bank scandal is the poster child. So for 8 years until 2015, over $230 billion was laundered through its tiny Estonia branch using more than 6,000 shell companies. So these firms had no real activity, they just had cross-border transactions. Banks performed KYC on companies and identified the ultimate beneficial owners or UBOs. They also screen jurisdictions and review transactional behavior. But here's the problem. KYC often relies on documents that can be faked. You have complex ownership chains with 10 or 20 layers that hide the real owner. And sometimes the person on the paper doesn't even exist. So now to the Nordics, where you have fake invoice factories and tax carousel fraud, where fake companies issue fake invoices to claim tax refunds or cover money laundering. Carousel schemes send goods in circles across countries, claiming tax refunds back, having never actually paid them in the first place. So these methods were widely reported by the Danish documentary The Black Swan, where a lawyer went undercover equipped with hidden cameras and wires. And she exposed the widespread fraud and money laundering occurring in Denmark. After airing on national TV, it created a massive stir, and even the Danish Prime Minister had to address the issues in a news conference. So banks monitor business-to-business payments with no matching activity, cross-reference VAT and tax numbers, and flag certain transactions for added scrutiny. They also rely on other checks being performed by accountants and auditors. However, many fake companies slip through initial KYC and operate long enough to do damage, even for years. In the Black Swan case, the criminals even had an insider in banks helping them go undetected. And unfortunately, that isn't rare. To help combat this, however, banks could use network analysis to spot invoice loops, verify suppliers through registries, and audit company age and activity. Next up, you have fake freelancing. So someone creates two accounts, one client and one freelancer, and fakes work to launder money. They're paying themselves and calling it income. So Europol has flagged platforms like Fiverr, Upwork, and Shopify as vulnerable. In some cases, crypto scam proceeds were funneled through these gigs to create fake income. Banks monitor for sudden income spikes from online platforms and conduct source of funds checks and large transfers. But here's the challenge: busy freelancers and fake ones can look similar on paper, especially if the payments are regular. Okay, so this one might surprise you, but laundering money through video games. So this can occur when criminals buy in-game currency like CSGO skins or Fortnite V-Bucks using stolen funds. Then they resell those assets on gray markets. So banks flag prepaid gaming cards, they track refund behavior, and block suspicious MCCs or merchant category codes. But here's the blind spot: transactions are small. It's $5, $20, or $50, and unless this became part of a bigger thing, rarely raise red flags. Okay, so crypto mixers are also called tumblers and are blockchain laundromats. You send in dirty crypto, it's mixed with all other users' funds, and what you get back is clean-ish and hard to trace. So Tornado Cash, which is a mixer, was sanctioned in 2022 after a North Korean group used it to launder over 455 million in Ethereum. The sanctions were lifted later, but the signal was clear. Many banks avoid crypto altogether. That won't last. As crypto matures, banks will have to adapt. Havala. So Havala is ancient but still relevant. It's a peer-to-peer cash transfer system based on trust. You give money to a broker in one country and a partner pays your contact in another country. There's no wires, there's no banks, and there's no records. So banks monitor high cash activity. They link accounts to money service businesses like Western Union and RIA and analyze transaction timing. But if no money enters the banking system, there's little for banks to monitor until Havala brokers need to offload or clean their cash. Real estate is perfect for laundering. It's expensive, stable, and physical, and criminals buy luxury property with dirty money all the time, often via shell companies, and then sell it to make a profit. Banks flag all cash real estate purchases. They check source of wealth and review company data. But now there's new rules. So in many countries, real estate agents, lawyers, escrow firms, and accountants are now covered by AML laws, not just banks. Watches, art, handbags, those hold value and are easy to resell, and many don't ask that many questions. So banks monitor large purchases, they track merchant categories and check for reselling behavior. But there's a gap. Most luxury merchants and sellers don't have AML obligations yet. And then lastly, you have fake loans. So fake loans equals fake legitimacy. Shell company A lends money to shell company B. On paper, it looks clean. In reality, it's just dirty money moving around. So banks can check loan documentation, repayment schedules, and perform UBO, or ultimate beneficial owner checks. But if auditors are fooled, so are the banks. So what could the banks do? Well, they can track how funds move after a loan. Do they support actual business, or do they just circle back? Well, paper is cheap, but money flow is real. So what do all these tactics have in common? Well, they make dirty money look boring, normal, and legit. From crypto to real estate, gaming to tax scams, laundering money today is fast, digital, and creative. And while banks are evolving, criminals are often 2 steps ahead. I'm Kevin. Thanks.